Every bar here is a real AAPL call trading right now. The floor underneath them. A call can never be worth less than stock minus the discounted strike, was proven in 1973. Not one contract breaks it. Here's the paper. That flaw is Theorem 1 of Robert Merton's 1973 paper, and is one of about a dozen results in it. The headline one is Stranger. Merton proves that an American call option, the kind that lets you exercise whenever you want, should almost never actually be exercised early. Not rarely, structurally never. We're going to prove that ourselves, on real numbers, and then find the one case where it breaks. The paper is Robert Merton, Theory of Rational Option Pricing, published in the Bell Journal of Economics and Management Science in the spring of 1973. The same season, the Chicago Board Options Exchange opened, the first listed options market in the US. It does two things. First, it derives restrictions every rational option price has to satisfy, using nothing but a no dominance argument. If one portfolio always pays at least as much as another, and sometimes pays more, it has to cost at least as much. No assumption about how stock prices move. Second, it re-derives Black-Scholes from weaker assumptions and extends it to puts and dividends. We'll build both halves. We use NumPy, SciPy for the statistics, and Y-Finance for live market data. No synthetic numbers anywhere in this notebook. 3 real inputs anchor everything that follows. AAPL's spot price, the risk-free rate from the 13-week Treasury bill, and AAPL's own trailing volatility, estimated from a year of actual daily returns rather than assumed. Every theorem gets tested against these. Here's the proof behind the chart we opened on, and it doesn't need a single assumption about how stock prices move. Compare two portfolios. Portfolio A, buy the option plus enough bonds to guarantee you have exactly E dollars at expiration. Portfolio B, just buy the stock. At expiration, if the stock finished below E, the option's worthless. But Portfolio A still has its E dollars in bonds, worth exactly what the stock is worth. If the stock finished above E, Portfolio A is worth exactly the stock price too. So A always ties B and sometimes doesn't even need to, meaning A can never be worth less than B today. Rearrange that and you've got the flaw. Look at the gap between the gray line and the red line. That's the whole point of the theorem. The naive intrinsic value, stock minus strike, is what most people think a call is worth if you had to exercise it today. Merton's flaw sits above that because it discounts the strike back to today's dollars. Waiting to pay E later is worth something, and that something grows with time to expiration. The blue line, actual market prices, sits above both. Every single contract. Look at where the market hugs the floor tightest. Deep in the money on the left, where almost the entire price is intrinsic value, and again far out on the right, where the option's nearly worthless and there's just nothing left to price. The gap opens up in the middle, right around the money. Pure time value, the part no arbitrage argument alone can pin down. The floor holds everywhere. It's just only binding at the extremes. This is the theorem, and the proof takes 4 lines, because Theorem 1 already did the hard work. If you exercise, you get stock minus strike. But Theorem 1 says the option's floor value is stock minus the discounted strike. And discounting makes a positive number smaller. So subtracting a smaller number leaves you with more. The option alive is worth strictly more than the option dead for any positive interest rate. Exercising early means voluntarily destroying value. Nobody rational does that. Let's check it isn't just true on paper. This is a control-variate trick. Subtracting the tree's own European price from its American price cancels almost all of the numerical error. So what's left is a clean estimate of the early exercise premium alone. Using AAPL's real strike near the money, real volatility, real rate, no dividend, the premium comes out to 0 to 4 decimal places. An American call and a European call, same strike, same expiry, worth exactly the same amount because the extra flexibility of early exercise is a right nobody would ever rationally use. This is the formula everyone knows as Black-Scholes, but Merton's route to it is worth pausing on. He builds a hedged portfolio, the option, the stock, and a risk-free bond, weighted so that market risk cancels out, and gets to the same formula with fewer assumptions than the original paper needed. What's striking is what doesn't appear in it. No expected return on the stock, no risk aversion, no assumption about how many options or bonds exist in the world, just the interest rate and the stock's variance, the two numbers we already pulled from real data. One number for volatility plugged into a formula from 1973 against real quotes trading this second. It's close near the money and drifts further away as strikes move out to the wings, which is expected, and which is exactly the crack in the formula the next section goes looking for. Here's the honest limitation, and Merton's own formula lets us find it. If equation 21 were exactly correct, there'd be exactly one volatility number consistent with the whole option chain. So run the formula backwards. Take the market's actual price and solve for whichever sigma reproduces it. Do that at every strike and compare. It's not flat. Deep in the money strikes imply meaningfully higher volatility than strikes near the money, a skew. The formula assumes the market agrees on one number for how risky the stock is. The market doesn't. That gap is precisely why options desks don't quote prices anymore. They quote implied volatility, strike by strike. And equation 21 is just the translation between the two. Merton's formula didn't get less useful because of this. It became the units the entire options market still thinks in. Once you can price a call, Merton shows the put isn't a separate problem. Its price is nailed down by the calls. Build a portfolio of a put, the stock, and a loan, and it pays exactly what a call pays at every possible outcome. Build the mirror image with a call, a short stock position, and a bond, and it replicates a put. Two dominance arguments pointed in opposite directions collapse into one equation. Buy the call, sell the put, and you've synthetically bought the stock on credit. The two lines track each other closely across every strike we have. The residual runs a few tens of cents on options worth tens of dollars, inside a typical bid-ask spread. Worth noting, it's not random noise. Theorem 12 is proven for European options, but real listed puts are American, and deep in the money puts do occasionally get exercised early. Look at the larger strikes. That's exactly where the residual drifts, because those puts carry a small early exercise premium the pure European formula doesn't know about. One more, and it's satisfying because the proof is almost visual. Buy a call at a low strike and a call at a high strike. Sell two calls at the strike in between, a position called a butterfly. Merton's dominance argument says, work out what that position pays at every possible stop price at expiration. It's never negative. So it can't cost less than zero today either. Real strikes on this AAPL chain are evenly spaced $5 apart, which turns the whole inequality into 3 numbers and 2 subtractions. Nearly every strike clears zero comfortably. There's one small dip below the line, and it's worth roughly a dime on a chain where the bid-ask spread runs $1 or more. That's not the market violating a 1973 theorem. That's quote noise, sitting inside a gap too small for anyone to actually trade against. Turn dividends on, and the proof of Theorem 2 breaks at exactly the step that used to make it work. Miss the ex-dividend date by holding instead of exercising, and you don't just miss a coupon. You watch the stock price drop by the dividend amount for nothing. Merton derives a simple condition for when this still doesn't matter. The exercise price has to be bigger than the dividend divided by the interest rate. Check it against AAPL's actual dividend first. AAPL's real dividend is 27 cents. Merton's threshold works out to around $29. Every real strike on this chain clears it several times over. So for AAPL specifically, early exercise never pays, exactly like Theorem 2 predicted, dividend and all. To actually see the mechanism the paper describes, we need a dividend that's large relative to the strike, not AAPL's real number, a stylized one, sized deliberately to cross the line. There it is, the region Merton calls C of tau. Below the boundary, holding wins, same as always. Cross it, and the red line, cash in hand from exercising right before the stock drops, pulls ahead of the blue line, holding on. That's a real premium for the right to exercise early, and it only exists because we turn the dividend up to something the option actually needs to worry about. Same theorem, same proof structure, it just flips once the one assumption it depended on stops holding. One more, because it's a genuinely strange result and it falls out for free. Let the warrant's expiration stretch to infinity. The present value of $1 paid infinitely far in the future is zero for any positive interest rate. So the discounted strike term in the floor vanishes entirely, no matter how large the strike is. The floor becomes exactly the stock price. And Merton already proved elsewhere that the stock price is also the ceiling. So a warrant that never expires is worth precisely the stock, regardless of its exercise price. $100 strike, $1 million strike, doesn't matter. A strike 50% above today's stock price, deep out of the money by any normal measure. Watch what happens as the time to expiration stretches out on this log scale. By 10,000 years, the value has converged almost exactly to the stock price, despite a strike nobody would call cheap. Give an option enough time, and the exercise price you'd eventually have to pay is worth essentially nothing in today's dollars. So the option becomes, in every way that matters, just the stock. Merton's own conclusion is modest about what he'd built. A model resting on avoiding dominance, nothing more, that reaches most of the way to Black-Scholes and extends cleanly to puts and dividends. He drops one line near the end about corporate liabilities being options on the value of a firm. That offhand comment became his own 1974 credit risk model, still how banks think about default risk on corporate debt today. Every check in this notebook ran against options trading on a real exchange this afternoon, not the simulation standing in for one. 53 years later, the flaw still holds. Thank you for watching, and I will see you in the next paper breakdown. Every number from this notebook, side by side. The flaw with zero violations, the early exercise premium at essentially zero without dividends, the volatility skew the constant sigma formula can't see, parity holding within noise, convexity holding everywhere but a gap smaller than the spread, and a stylized dividend showing exactly when the no early exercise rule stops applying. One 1973 theory paper checked against a market trading in real time.